seem to consistently get it wrong and look for that. So you get to know people, and you get to know who's the one you got to put the brakes on a little bit, or the reins on, and who's the one you have to push a little bit. We haven't, at least in the markets that we're on in Asia, it's Singapore, Hong Kong, China, you can get rent comms, you can get, you can get sales comms, the big brokerage firms are all over there. The hard part about the comps over there is there's such a broad diversity and difference in asset types
getting
and
apples to
location.
apples and
Whether or not it's a appropriate comp, to me, is the bigger issue than getting the comps.
Yeah, Rob, you want to make a point?
No, I was just going to echo that.
But I think there's a learning point for all the students in the audience here, and I mean, you've just heard several views on that, and as you go into the job market, I think these are some important points to convey, and you got to think what your value added is to in your home country or even here, and it's that real estate. I think it's something we do in the same language everywhere. I mean, there are no Chinese numbers, no Indian numbers, no Hungarian numbers. Numbers are numbers, and the math of real estate has become a pretty consistent institutional standard. And I think what you can export back into your native countries are those best practices you've learned here. And you've certainly been in the United States during a very lessons learned era. Obviously, none of us anywhere in the U.S. have all the answers, and we've created the problem, and we've met the enemy, and it's us. And so, this is up to all the students here, so that next generation of real estate doesn't wind up in the same mess we've all been in the last couple of years, trying to unwind the ego part of real estate and the bubbleness of real estate and the greed that has kind of consumed our industry. So that's not a paid political announcement, but I just think that I think you need to speak confidently that you've been here at MIT and other great schools here in Boston, and convey that you get it, because you've heard from people like on this panel or in your studies and your case studies, and you realize that there are techniques you can apply into some of these challenges of emerging markets, because guaranteed, absolutely guaranteed, that same mess that we've been in, it's going to be in all your countries at some point. The old joke when I was living in Shanghai, I used to think that the Chinese are going to become so adept at real estate that one of these days they're going to have their own RTC and their own TARP programs. It's kind of a left-handed compliment, but the same things that drove us into this kind of failure mode is always out there in your home country. So just beware and remember these kinds of moments and what some of these guys are saying about, it's because it all comes down to benchmarking. It all comes down to comparables. And, okay, so I'm not to pick on a Cushman or JLL. Scrutinize the numbers, because, the devil's in the details, as we've kind of been saying up here. Not to get too academic for a moment, but we're all students of the industry. So getting back to some of the issues of looking at risk and reward, because I think that's the kind of the theme in the last few minutes we have here. First I'd just like to the audience, any questions that anybody has, or want clarification of any of the points we've raised, or right over here. You right there. Yeah.
I want to focus on Brazil. I know that the panel have had experience with Sam Zell and asked
He bought Gafisa and
recently sold that.
it's recently sold that. Right. Yep.
Where are we in the cycle of Brazil? Are there still opportunities in what sectors are there? And then also what kind of financing is available? There's historically been low leverage, low LTV rates in Brazil. Is there any sort of financing?
I'll just jump in on the first part, and then you can follow. I think where we're at in Brazil is you've just completed one cycle. That first wave of international investors, the Heinzes, the Tishman Spires, the Paladins, the Zells, they all came in, and they entered into the market, building Class A office buildings and warehouses, and sort of recapitalizing troubled companies, and kind of taking advantage of the supply-demand imbalances. And so they've been remarkably successful, and they all generated outsized returns. And I think this next wave of investment and opportunity is really in the shopping center sector. It's certainly in the warehouse and aspects of the residential market. I mean, there's been some tremendous growth in the low moderate income sectors of Brazil. they're blessed by having great government programs. I wish our FHA and Fannie and Freddie were as good as what Caixa is and FGTS is in Brazil. But it's a real demand-based program. They don't have any of the subprime and securitization problems that created baggage in our housing market. So to the point about financing is the challenge here. Money's expensive. They need to balance inflation versus growth, and they have huge government deficits coming up. So Dilma wants to get the rates down to low single digits. I don't know if she's ever going to get there, but it's they have huge capital requirements coming up. They have the World Cup in 2014. They've got the Olympics in 2016 or 18. It's just 2018. So it's that huge sucking sound you hear is going to be Brazil, needing all that capital for infrastructure and the facilities. On the other hand, they feed China. They have a huge commodity export business. They've got Petrobras and oil. So but the currency is one of the most overvalued in the world, right? Peter, you want to add to that? You were just there.
No, I think you're. I agree with it with everything you said. I mean, there are still specific opportunities in Brazil. You can even look at the Sao Paulo office market, and if you're in the right location, you probably do just fine. If you're in the wrong location, right now it looks like it's getting a little bit overbuilt. Most of the returns that I've seen in Brazil have actually been accomplished with pretty low leverage. So that's pulled some of the risk out of it. Infrastructure is, as you mentioned, is a major issue. The airports are in miserable shape. A lot of the roads need big improvement, and there just isn't enough money to do that. In some of the more recent transactions, additional leverage is available, and sometimes the cost of funds is pegged to one index, and leases are pegged to another index, and you always have that positive spread. So there's a little bit of protection built there, and where it goes, I don't know. Overall, I'm very positive on Brazil, but I think that a lot of capital has been drawn into it, so I just be cautious for the next couple of years, probably a little bit more conservative than would have been 2, 3, 4 years ago.
And also infrastructure funds, it's a great area for job growth, and I mean you could take your real estate brain and put it into infrastructure funds and be very successful. I don't think there's enough good sort of real estate private equity thinking in that sector.
No, I mean you could almost take agricultural land that's used for grazing right now,
right,
and turn it into use it for producing sugarcane, and there's an arbitrage opportunity on something as simple as that.
Any other questions from the audience? Yes, sir. We're going to do the karaoke? Oh, sorry.
I would like to ask the panelists who have the experience of investing in the real estate in China. As we know, like the central government in China is kind of want to cool down the market, the real estate market a bit, and they increased the interest rate several times this year, and also increased the Federal Reserve rate for the banks to stop them to lend, too much for the real estate development. And also the real estate market, the commercial real estate market in China, for example, the Grade A office market in major cities like Shanghai and Beijing, though their rents are still gradually going up, but their vacancy is like close to 10 to 15%. So there is kind of some risks of the market will going down in future. So I'm wondering your opinion about what would your investment strategy towards in China, and also what kinds of assets are you looking for? Thank you.
Anybody sitting around like it?
I would say we have a China fund which we're about 75% invested, and our portfolio manager I was speaking to several weeks ago because of the housing. And sort of the press here in the United States is that there's considerable overbuilding in a number of cities. And the portfolio manager said, well, that is true, but it's such a different situation than the United States, which with its migration from rural to urban, that in the worst case, you have close to maybe a 2-year excess supply in housing, which will clearly get absorbed. And so pretty comfortable with that situation. I can say less about office than I can about housing. But to your comment about the government, a couple people, we had a couple of internal sessions discussing China, and we're looking at introducing a fund too later this year. And we were debating that very issue of the government. And sort of, I thought there was one off-the-cuff humorous comment that maybe was quite poignant, which is that the Chinese government manages towards a successful economy, and they have the ability to do it. Whereas in a democracy, whether it be here or in European countries, it's much more scattered. So we're pretty comfortable with what's going on over there. They're still in a vein of making things happen to a good end economically.
I think the thing about China that scares me is that they're, in some of these high growth and overstocked and oversupplied markets, that they're starting to have capital value indexing in the housing market. In other words, their property values can't exceed the GDP growth, which is kind of like rent control in New York City. I don't know, it's a command control market. There's always, as a Westerner, you never like to see that, and it's always a question mark. I lived in Shanghai and Beijing and built shopping centers and residential in the 90s, and it was a different world back then. Now it seems to be very superheated and at times bubbly.
A couple of things I would say. One, China raising their bank rates, I don't think has that much effect on values. And the reason why is I actually think, and you see this all throughout Asia, their lending market is much more sane than the U.S. I mean, the ability to get above 50% leverage in Asia is very difficult. And even if you can get above 50%, their annual resize, so it doesn't matter what the term of the loan is, they'll resize it every year, and they will resize. If they think values have gone up or down, they'll just make you pay it down. So you really, over in Asia, have to manage your balance sheet, much more effectively than I think U.S. Real estate people are trained to do. Two, and we've done a lot in office, and it's actually been, over in Asia, what you see is a lot more volatility in rates. So your rates can go from here to here very fast. And, over there, it's, $12, $20 a month, not, $12, $20 a year. So we actually went in because they're so volatile, and we were able to buy at rates that had dropped about 40 to 50%. And rather than buying, I'll call it reposition assets, where you have to maybe do some work, because doing work is overrated. If you really ask people around the world how successful you are in all of the value-added opportunities, it's maybe 50-50. It looks good on paper. It's hard to execute in reality. But the volatility in the rates, the rental rates, is so much greater. We were actually able, and over there they're a little bit more worried, we were able to buy better quality assets where the rates had dropped. The other thing I would say is the bigger concern, and we spent a long time with this yesterday on the investment committee in Asia, is the negative real interest rates. I mean, if you look at, because you're pegged, it's not the bank rates that are the issue. It's, they're more nervous, about what happens if U.S. interest rise, because they really have a negative rate. And it's a market that's schizophrenic. You see some extremely long established companies buying and selling. And they're, as far as I can tell, there's not consistency. So there's just, I think, a lot of different thinking. But I think it's due to the biggest risk over there now is these negative real interest rates that are driving the flows of capital.
And it is a buy and flip market as opposed to real primary residence demand. Any other questions around here? Got all these students in the back. And how? Where are you from in China? Where? What city? Yeah, can we raise the hands? How many students are from other countries? Okay. There's final questions here. So, I gave you each $100 million. $100 million is not what it used to be, but suppose you had $100 million. Where would you allocate it and why? Peter, you want to go for that? Not to put you on the spot, but
Okay. If I had $100 million to allocate,
yeah.
If I look at the most recent strategies that I've looked at, basically distress-related acquisitions in the U.S.